So, guys, in the previous lecture, you have learned about technical analysis. It's a method of forecasting the price, and you have already looked at line chart. So, line chart is easy to identify, right? Easy to understand, and anyone can easily identify and understand line chart. And it gives us, or it is calculated with the help of a closing price of a stock. So, now we are going to look at candlesticks pattern and basics of candlesticks. So, have you heard about candlesticks before? Have you heard about candlesticks before? So what is candlesticks? So a candlesticks gives us four data. It gives us high. So a line chart gives us one data. Line chart gives us one data. Line chart and candlestick chart. A line chart gives us one data, which is the closing price. But a candlesticks that candlestick gives us four data. It gives us high, low, open, and close. It gives us four data. It gives us high, low, open, and close. So it gives us more data than a line chart. That's why we are using candlesticks. As a trader, we need more data in order to understand the market. We need more data in order to understand what the market is trying to tell you. So candlesticks and price pattern and price action is the language of the market. If you are able to understand this language, you can easily identify what the market is trying to tell you. That's the point. So the market is trying to communicate with you with the help of a candlesticks and price action. If you are able to understand and if you are able to read price action and candlesticks properly, you will be able to communicate with the market and take profitable trades. So we are depending on candlesticks because of the main reason, because we have four data there. We are not depending on a line chart because we have only one data. Candlestick gives us four data. It gives us the high, low, close, and open. So then we have two part for a candlesticks. We have let's move on to the candlesticks, and I will be talking about that. So we have two part for a candlesticks. We have two part. We have a body and a wick or shadow. We have two part for a candlesticks. We have body and we have wick or shadow. So we have wick or shadow and a body. So if you look at here, if you look at the green area and if you look at the green candlesticks here, this area, the green area is called as the body, and the black area, the black line is called as the wick or shadow. So you need to keep that in mind. The green area is called as body, and the wick or the line is called as the wick or shadow. So we have in here you can see that two type of candlesticks, right? One, you can see a green candlesticks, and the next thing is you can see a red candlesticks. If the price is going up, you can here the price is going up. In the first candlesticks, the price is going up. That's why it is green. In the second candlesticks, the price is going down. That's why it is red. So if the price is going up, close is greater than open. You need to understand that. If the price is going up, you can see that the price is going up. The open close is greater than the open. And if the price is going down, open is open is close is less than the open, right? Close is less than the open. So you need to understand that. So like we told in the beginning, a candlestick gives us four data, right? It gives us high, low, open, and close. So we'll be learning that quickly. So you'll be looking at, let's say the price open at 100, right? So the market open at 9:15, right? The market open at 9:15, and let me draw a price. So the price market opened at 100 point, right? And the chart went up and came back down and started to go up and came like this. Okay, so the market opened at 100, and after that the price went down at 9:15, right? At 9:15 the price opened at 100, and after that the price came down to a point of, let's say this is 90. It came to 90. Okay, let's say it came to 90, and after that it went up, and if you don't know the timing of the market opens at 9:15 and closes at 3:30. So let's say at 3:30 during the close, you can see that on that day the price went up, after that came back down, right? At 3:30 the price of the stock is uh, let's say 200, right? Let's say 200. At close at 3:30 the price of the stock is 200. and after that it made a low at 90, and before closing at 3:30 it made a high of 250. Let's say 250, right? So we have four datas here, right? We have four datas. If you look at here at 9:15, the market opened at 100, right? So if you look at a candlesticks, it gives us four data, right? It gives us open, low, high, and close. So if you look at here, the open is 100, right? The open is 100, and the low is 90. The price made a low of 90, and the high is 250, and the market closed at 3:30 at 200, right? So we have four datas in the candlesticks. So if you're looking here, the price data will be like this. The open will be 100, the low will be 90 here, the close will be 200, and high will be 250, right? So, it gives us four datas. So if you're looking at a line chart, it gives us only one data, which will be the 200. But when it comes to candlesticks, it gives us four data. That's why traders are depending on candlesticks rather than any other format. So we are depending on candlesticks because it gives us four datas comparing to a line chart. So it gives us high, close, open, and low. Uh, so whenever the price open and the close is higher than the open, it is a green candle. The body is green, and whenever the price is going down, the body is red. So if the open is 100, the low is 90, 200, and 250. So let's say what if the opposite is happening? So let's say the market opened at 9:15 at 100. Let's say it opened at 100, right? It opened at 100. Later, let's say the price went down, made a high at, let's say at 9:15, the market opened at 10:30, it went to 150, right? It went to 150, right? And at that day, the maximum high the stock made was 150. And the close at 3:30, the market closed at, let's say, 50 and made a low of 25. So that's how it works. It gives us four data, right? But if you're looking at the line chart, it gives us only one data, which is the closing price. So a candlesticks gives us four data. So the one more thing which you need to keep in mind here is, I hope most of you have already know what a candlesticks is, but I'm just elaborating. Like every time frame, you can look at a candlesticks at any time frame. So if you're looking at a candlesticks at 1 minute, if you're looking at 1 minute, each candle, each candle represent 1 minute, right? So if you're looking at 3 minute, each candle represent 3 minute, right? So you need to understand that this three 1 minute candle is equal to one 3 minute candle, right? So you can see that we have three candle here, we have one candle here. So if you're looking at a time frame, if you're looking at trading view, and you can see a time frame there. So if you're looking at 1 day time frame, each candle will represent 1 day. Let's say this is 10th of Jan. So one candlestick will represent 10th of Jan. On 11th of Jan, we have the next candlestick. So if you're looking at 1 hour, each candle will represent 1 hour. So during that 1 hour, it will give you the data of the open, high, close, and low of that 1 hour. If you're looking at 1 day, it give you the data of open, high, low, and close of that 1 day period. So you need to keep that in mind. I hope you are clear. We have green candle and we have red candle. Green represent when the price is going up, and red represent when the price is going down. So I hope you're clear with that, and we'll be moving forward.